Welcome to Finance for Sleep. I am Simon Grant and it is a pleasure to have you here. The mission of this channel is to transform the complex, often stressful world of money into a landscape of absolute calm. We believe that the most technical details of finance possess a natural steady rhythm that can settle an overactive mind. Whether we are exploring market history or tax codes, our goal is to provide a sanctuary where high-level information meets low-level stimulation. For those who wish to delve deeper into these topics, we have provided additional resources and references in the links below. Some of these are affiliate links which help support the channel's mission at no additional cost to you, allowing us to continue building the Finance for Sleep library. Tonight, we begin the second chapter of a series I call Boring Finance from A to Z. Together, we are continuing our comprehensive library of the language of wealth, a fiscal dictionary designed to be as informative as it is monotonous. Before we move into the ledger, a few necessary words on safety and professional boundaries. This series is designed specifically for relaxation. Therefore, you should not listen to this audio while driving or operating heavy machinery. For the most immersive experience, it is recommended to listen with headphones at a low and comfortable volume. This content is for educational, entertainment, and lack of entertainment purposes only. It does not constitute financial, legal, or medical advice. I am not a lawyer, medical professional, or financial advisor. You should not act or refrain from acting based on anything you hear in this video. Always consult with a qualified, licensed, and certified professional before making any decisions. If you find these sessions helpful for your rest or for your growth, please consider joining our community by subscribing. It helps us continue to grow this channel and make more videos that bore you to sleep. Now, let us continue towards a peaceful night's sleep. Tonight we will be covering financial words beginning with the letter B. From backdating to buyouts, each word will be defined, explored, and eventually laid to rest. There is no rush and no requirement for your full attention. Let the terms and the quiet logic of finance drift through the room as you settle into the stillness. Make yourself comfortable as we continue our journey through finance, one letter at a time. Backdating. The definition of the word backdating is the practice of marking a document, contract, or financial instrument with a date earlier than the date on which it was actually created or signed. In some contexts, backdating is a legitimate and legal practice. An insurance policy may be backdated to provide coverage from an earlier date, with the premium adjusted accordingly. In other contexts, backdating is fraudulent. Executives who backdate stock option grants to coincide with a lower share price effectively award themselves greater compensation than was authorized. Picture a clock on a wall. Someone reaches up and moves the hands backward. The clock now shows an earlier time. The world, however, has not changed. Backdating does not alter events. It only alters the record of events. When the record is a legal or financial document, altering it without disclosure can constitute fraud. Several major corporate scandals in the early 2000s involved the backdating of stock options. Investigations by regulators resulted in significant fines, restatements of financial results, and in some cases criminal charges. The lesson of backdating is simple. Documents record what happened and when. Altering that record for personal gain is not a gray area. It is deception. Bail-in. The definition of the phrase bail-in is a mechanism by which a failing bank is rescued by requiring its creditors and depositors to absorb losses, rather than by using public funds. A bail-in is the opposite of a bailout. In a bailout, external funds, typically from governments and therefore taxpayers, used to rescue a failing institution. In a bail-in, the losses are borne internally. Shareholders are wiped out first. Then bondholders have their debt converted to equity or written down. In extreme cases, large depositors above the insured threshold may also be affected. Picture a ship taking on water. In a bailout, a rescue vessel arrives from outside to pump the water out. In a bail-in, the passengers themselves are required to bail with buckets. The bail-in framework was introduced following the 2008 financial crisis, when the scale of government bailouts generated significant public anger. The intention is to ensure that those who invested in or lent to a bank bear the consequences of its failure, rather than transferring those consequences to the broader public. The bail-in regime requires that banks maintain sufficient loss-absorbing capacity at all times, so that a resolution can be conducted without systemic disruption. Bailout. The definition of the word bailout is the provision of financial assistance to a failing company, bank, or economy, typically by a government or international institution, to prevent collapse. A bailout is an intervention of last resort. Picture a building on fire. The fire has spread too far for the occupants to contain it themselves. External help arrives. The structure is saved, though not without cost. Governments provide bailouts when they judge that the consequences of a failure would be too severe to allow. The term used is systemic risk, the danger that one failure will trigger a cascade of others. The 2008 financial crisis produced some of the largest bailouts in history. Governments in the United States, the United Kingdom, and across Europe injected trillions of dollars into banks and financial institutions to prevent a complete collapse of the global financial system. Bailouts are deeply controversial. Critics argue that they create moral hazard, encouraging risky behavior by institutions that believe they will be rescued if things go wrong. Supporters argue that in a genuine crisis, the alternative to a bailout is often far more damaging than the bailout itself. The debate between these two positions is one of the enduring arguments in financial policy. Balance transfer. The definition of the phrase balance transfer is the process of moving an outstanding debt from one credit account to another, typically to take advantage of a lower interest rate. Balance transfers are most commonly associated with credit cards. Picture a container of water. The water represents a debt. It sits in one vessel, accumulating cost over time in the form of interest. The balance transfer moves that water into a different vessel, one where the cost of holding it is lower, at least for a defined period. Many credit card issuers offer promotional balance transfer rates, sometimes as low as 0%, for an introductory period of 6 to 24 months. The intention is to attract new customers by allowing them to reduce the cost of existing debt. A balance transfer fee is typically charged at the time of transfer, often between 1 and 5% of the amount moved. The risk of a balance transfer is complacency. If the balance is not paid off before the promotional period expires, the remaining amount reverts to the standard interest rate, which may be significantly higher. Used with discipline, a balance transfer can be a practical tool for debt reduction. Used without a repayment plan, it can extend the cycle of debt rather than resolve it. Balance of payments. The definition of the phrase balance of payments is a record of all economic transactions between the residents of a country and the rest of the world over a given period. The balance of payments has two main components: the current account, which records trade in goods and services, and the capital and financial account, which records investment flows. Picture a large ledger belonging not to a company but to an entire nation. On one side, everything flowing in. Exports. Investments received. Remittances. On the other side, everything flowing out. Imports. Capital sent abroad. Debt repayments. In theory, the balance of payments always balances. What flows in must equal what flows out when all accounts are considered together. A country that consistently imports more than it exports runs a current account deficit. This is not inherently problematic, but it must be financed by capital inflows from abroad. The United States has run a persistent current account deficit for decades, offset by its status as a destination for global investment. The balance of payments is compiled and published by central banks and national statistical agencies, typically on a quarterly basis. It is studied closely by economists, policymakers, and international institutions such as the International Monetary Fund. Balance sheet. The definition of the phrase balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholders' equity at a specific point in time. Picture a large oak desk in a quiet office after business hours. The lights are dim. On the desk sits a single sheet of paper, ruled into two columns. On the left, what is owned. On the right, what is owed. The balance sheet does not move. It does not predict. It simply records what is, at this precise moment, true. It is one of the three core financial statements, alongside the income statement and the cash flow statement. The word balance refers to the fundamental equation, assets equal liabilities plus equity. Both sides must always be equal. Assets on a balance sheet are divided into current assets, which can be converted to cash within a year, and non-current assets, which are held over a longer period. Liabilities are similarly divided into current liabilities, due within a year, and long-term liabilities, due beyond that horizon. The difference between total assets and total liabilities is shareholders' equity, also known as net worth or book value. A strong balance sheet is characterized by manageable debt, healthy liquidity, and substantial equity. It is the foundation upon which financial confidence is built. In practice, a balance sheet is reviewed quarterly and annually by investors, auditors, and regulators to assess the financial health of an organization. Balloon payment. The definition of the phrase balloon payment is a large, lump sum payment due at the end of a loan term, following a series of smaller regular payments. Balloon payments are common in certain mortgage structures and commercial loans. Picture a journey across a very long plain. For most of the journey, the road is flat and manageable. Small distances are covered at steady intervals. At the very end of the plain, however, the road rises steeply. The final climb is significant. Borrowers who agree to balloon payments often do so because the lower initial payments are more manageable in the short term. The risk is that the borrower must have the funds available, or must refinance the loan, when the balloon payment becomes due. In commercial real estate, balloon payments are particularly common. A property owner may make interest-only payments for 5 or 7 years, with the full principal due at the end. This structure assumes the borrower will either sell the property or refinance before the balloon comes due. The word balloon refers to the way the final payment swells in comparison to the ones that preceded it. Like a balloon inflated slowly, the obligation grows silently in the background. Careful financial planning is essential when a balloon payment is part of a loan structure. It will arrive, on schedule, regardless of circumstance. Bank draft. The definition of the phrase bank draft is a payment instrument issued by a bank on behalf of a payer, guaranteeing that the specified funds are available and will be paid to the recipient. A bank draft differs from a personal check in one important way. A personal check draws on the payer's account and may bounce if funds are insufficient. A bank draft is guaranteed by the bank itself. Picture a sealed envelope handed across a counter. Inside is not a promise from an individual, but a promise from an institution. The recipient knows it will be honored. Bank drafts are used in large transactions where the recipient requires assurance of payment before releasing goods or completing a transfer. Real estate transactions, large equipment purchases, and international trade settlements frequently involve bank drafts. The bank withdraws the funds from the payer's account at the time of issue. The money is effectively set aside, reserved exclusively for the payment specified. Bank drafts carry a small fee, reflecting the administrative cost and the guarantee the bank provides. In an era of electronic transfers, bank drafts have become less common for domestic transactions. They remain relevant in international contexts where electronic systems are not available or trusted. Bank reconciliation. The definition of the phrase bank reconciliation is the process of matching the balances in an entity's accounting records to the corresponding information on a bank statement. Imagine a person sitting at a kitchen table late in the evening with two documents side by side. One from the bank. One from their own records. They move slowly down each column, comparing entries line by line. Where the numbers agree, they make a small mark. Where they do not, they pause. Bank reconciliation is performed monthly in most organizations. It exists to detect errors, identify unauthorized transactions, and ensure the accuracy of financial records. Discrepancies are not always the result of error. They may reflect timing differences, such as outstanding checks that have not yet cleared. A deposit in transit is a payment that has been recorded in the company's books but has not yet appeared on the bank statement. An outstanding check is one that has been issued and recorded but not yet presented to the bank for payment. Bank reconciliation is a fundamental internal control. It creates a regular opportunity to detect fraud, identify data entry errors, and confirm that cash balances are accurate. In large organizations, bank reconciliation may be automated. In smaller ones, it remains a manual process performed by an accountant or bookkeeper. The quiet discipline of reconciliation is not glamorous. But it is the kind of steady, methodical work that keeps financial systems reliable. Bank run. The definition of the phrase bank run is an event in which a large number of depositors simultaneously withdraw their funds from a bank, typically because they fear the bank is or will become insolvent. Bank runs are driven by fear, and fear spreads quickly. Picture a queue forming outside a bank at dawn. One person heard a rumor. They told two others. By mid-morning, the queue stretches around the block. Each withdrawal reduces the bank's available liquidity. As news of the queue spreads, more depositors join it. The very act of withdrawing funds makes insolvency more likely, creating a self-fulfilling prophecy. Banks do not hold all deposits in cash. They lend the majority of deposits out as loans. This is the foundation of the banking system, but it also means that no bank can meet a simultaneous demand for all deposits. Bank runs were a recurring feature of financial history before the introduction of deposit insurance. The establishment of the Federal Deposit Insurance Corporation in the United States in 1933 was a direct response to the epidemic of bank runs during the Great Depression. Deposit insurance reassures depositors that their funds, up to a specified limit, are protected even if the bank fails. This knowledge reduces the incentive to withdraw at the first sign of trouble. Despite these protections, bank runs still occur, particularly when deposits exceed insured limits or when confidence in the institution collapses entirely. Bankruptcy. The definition of the word bankruptcy is a legal process through which individuals or businesses that cannot repay their debts seek relief from some or all of their obligations. Picture a door with a padlock on it. The windows of the building behind it are dark. A small notice has been affixed to the frame. Inside, the machinery is still. The accounts are frozen. In the United States, the most common forms are Chapter 7, which involves liquidation of assets, and Chapter 11, which allows for reorganization and continued operation. Chapter 13 bankruptcy allows individuals to restructure their debts and repay them over a 3 to 5 year period, while retaining their assets. Bankruptcy is not the end of a financial story. It is a legal mechanism designed to provide an orderly resolution to insolvency. The word bankruptcy is derived from the Italian bancarotta, meaning broken bench, referring historically to the practice of breaking the workbench of a merchant who could no longer pay their debts. When a business files for bankruptcy, an automatic stay is imposed. This halts all collection actions, lawsuits, and foreclosures while the process unfolds. Creditors are ranked in order of priority. Secured creditors are paid first. Unsecured creditors receive what remains. Shareholders are last in the order of priority. In many bankruptcies, they receive nothing. The stigma of bankruptcy has diminished over time. Many well-known companies have emerged from bankruptcy proceedings stronger and more focused than before. Bargaining power. The definition of the phrase bargaining power is the relative ability of one party in a negotiation to influence the terms of a transaction or agreement. In economics, bargaining power is shaped by the availability of alternatives, the size of the parties involved, and the urgency of the need. Picture two people sitting across a table. One has many options. The other has very few. The one with many options holds the greater bargaining power. They can walk away. They can wait. Porter's 5 forces framework identifies the bargaining power of buyers and the bargaining power of suppliers as 2 of the 5 key forces that shape industry competition. A large retailer purchasing from hundreds of small suppliers holds significant bargaining power. It can demand lower prices, faster delivery, and more flexible terms. A small business purchasing from a single dominant supplier holds very little bargaining power. It must accept the terms offered, or find an alternative that may not exist. In labor markets, bargaining power determines wages. When unemployment is low and skilled workers are scarce, employees hold greater bargaining power. When unemployment is high, employers do. Understanding bargaining power is essential in any negotiation, commercial relationship, market analysis. Barriers to entry. The definition of the phrase barriers to entry is the obstacles that make it difficult for new competitors to enter an industry or market. Barriers to entry can take many forms. High startup costs. Regulatory requirements. Patents and intellectual property. Established brand loyalty. Economies of scale enjoyed by existing players. Picture a walled city. People inside move freely. Merchants and traders prosper. Outside the walls, others wish to enter. But the gates are narrow, the entry fees are high, and the established residents resist new arrivals. Industries with high barriers to entry tend to have fewer competitors and higher profit margins. Warren Buffett has referred to sustainable competitive advantages as economic moats, drawing on the image of a water-filled trench that protects a castle from invasion. Network effects create a form of barrier to entry. When a product becomes more valuable as more people use it, a new entrant must overcome the gravitational pull of an established network. Regulatory barriers are common in industries such as banking, pharmaceuticals, and utilities. Obtaining the necessary licenses and approvals can take years and cost significant sums. Sunk costs also deter entry. If a new competitor must invest heavily in equipment or infrastructure that cannot be recovered if the venture fails, the risk of entry is amplified. Low barriers to entry produce competitive markets with many participants, lower prices, and thinner margins. Basis point. The definition of the phrase basis point is a unit of measurement equal to 1/100th of 1%, or 0.01%. Think of a very long ruler. One end represents 0. The other end represents 100%. A single basis point is a mark so small it is barely visible to the naked eye. And yet, in finance, it carries great significance. When a central bank raises interest rates by 25 basis points, it is raising them by 1/4%. Basis points are used to avoid ambiguity. Saying a rate rose by 1% when discussing a rate that was itself 1% could mean very different things. Basis points remove that ambiguity. The abbreviation for basis points is BPS, sometimes pronounced BIPS. In bond markets, yield spreads are quoted in basis points. A corporate bond trading at 150 basis points above a government bond means its yield is 1.5 percentage points higher. In asset management, fees are often quoted in basis points. A fund charging 50 basis points charges 0.5% of assets annually. The difference between 50 and 100 basis points may seem small in isolation. Compounded over many years and applied to large sums, however, it becomes substantial. This is why investors scrutinize fund fees carefully. A seemingly small difference in basis points, multiplied across decades of compounding, can represent a significant portion of long-term returns. Basis risk. The definition of the phrase basis risk is the risk that the value of a hedge does not move in perfect correlation with the value of the underlying position being hedged. A hedge is an investment made to reduce the risk of another investment. But no hedge is perfect. Imagine two pendulums hanging side by side. They were designed to swing in opposite directions, so that when one rises, the other falls. But they do not move in exact mirror image. There is a slight difference. That difference is the basis risk. Basis risk arises when the instrument used to hedge does not perfectly match the asset being hedged, due to differences in timing, geography, or contract specifications. An airline that hedges fuel costs using crude oil futures faces basis risk because the price of jet fuel does not move in perfect lockstep with the price of crude oil. A farmer who sells futures contracts on a standard grade of wheat faces basis risk if the wheat they actually produce differs in quality or location from the contract specification. Cross-currency hedges introduce basis risk when the currencies involved are correlated but not identical in their movements. Basis risk cannot be eliminated entirely. It can only be understood, measured, and managed. The goal is not a perfect hedge, but a sufficiently effective one. Bear market. The definition of the phrase bear market is a market condition in which the prices of securities fall by 20% or more from recent highs, accompanied by widespread pessimism and negative investor sentiment. Picture a forest in late autumn. The leaves have fallen. The ground is cold. Animals move slowly, conserving energy. There is nothing dramatic about a bear market in the moment. It is a slow, heavy decline. Days pass. Weeks pass. The numbers continue lower. The bear is thought to represent a downward swipe of the paw, in contrast to the upward thrust of the bull. Bear markets have historically lasted an average of 9 to 14 months, though some have extended far longer. They are a natural feature of market cycles, not an anomaly. Bear markets are typically accompanied by rising unemployment, declining corporate earnings, and reduced consumer confidence. During a bear market, investors often move capital into defensive assets such as government bonds, gold, and cash equivalents. Not all sectors decline equally. Consumer staples, utilities, and healthcare tend to hold their value more reliably than cyclical sectors such as technology or luxury goods. Short sellers profit in bear markets by borrowing securities and selling them, hoping to buy them back at a lower price. History shows that bear markets, however prolonged, have always eventually given way to renewed expansion. Bear trap. The definition of the phrase bear trap is a false signal in financial markets that causes short sellers and bearish investors to believe that a declining asset is continuing to fall, when in fact it is about to reverse upward. A bear trap is a deception of momentum. Picture a hunter who follows tracks through the snow, convinced they are closing in on their quarry. But the tracks double back. The animal is elsewhere entirely. In markets, a bear trap occurs when prices break below a key support level, encouraging traders to sell or take short positions. Then, unexpectedly, prices reverse and move sharply higher. Those who sold or shorted are now on the wrong side. The trap has closed. Bear traps are most dangerous in thinly traded markets, where small volumes can create misleading price movements. They are also common near heavily watched technical levels, where the predictability of other traders' behavior can be exploited. Experienced traders look for confirmation before acting on a breakdown. Low volume, rapid reversal, and failure to sustain below support are signs that a move may be a bear trap. Patience is the primary defense. Acting on the first sign of a breakdown, without confirmation, is how most traps are sprung. Behavioral finance. The definition of the phrase behavioral finance is a field of study that examines how psychological influences and cognitive biases affect the financial decisions of individuals and markets. Traditional finance theory assumes that investors are rational, that they process information correctly and act in their own best interests. Behavioral finance challenges this assumption. Picture a scale designed to weigh facts objectively. But the hands holding it tremble slightly. The reading is influenced not just by what is being weighed, but by the state of the person doing the weighing. Cognitive biases distort financial decision-making in predictable ways. Loss aversion causes investors to feel the pain of losses more acutely than the pleasure of equivalent gains. This leads to holding losing positions too long and selling winning ones too soon. Overconfidence leads investors to overestimate their ability to predict market movements, resulting in excessive trading and under-diversification. Anchoring causes investors to place undue importance on the first piece of information they receive, such as the price at which they bought a stock, when making subsequent decisions. Herd behavior causes individuals to follow the crowd, buying when markets are rising and selling when they are falling, often at precisely the wrong time. Behavioral finance does not claim that all investors are irrational at all times. It claims that predictable patterns of irrationality exist, and that understanding them is essential for sound financial decision-making. Benchmark rate. The definition of the phrase benchmark rate is a standard interest rate used as a reference point for setting other interest rates across financial markets and loan agreements. Benchmark rates serve as the foundation upon which the cost of borrowing is built throughout the economy. Picture the base of a very tall structure. The foundation does not draw attention to itself, but everything above it depends on its stability. For much of the late 20th and early 21st centuries, the London Interbank Offered Rate, known as LIBOR, served as the primary global benchmark rate. Following concerns about manipulation, LIBOR has been phased out and replaced by alternative rates, including the Secured Overnight Financing Rate in the United States, known as SOFR. Central bank policy rates, such as the federal funds rate set by the United States Federal Reserve, also function as benchmark rates. They influence the cost of overnight borrowing between financial institutions. Mortgages, corporate loans, and consumer credit products are frequently priced at a spread above a benchmark rate. When the benchmark rate rises, so does the cost of variable rate debt. The benchmark rate is therefore one of the most consequential numbers in finance. Its movement affects millions of borrowers and trillions of dollars of contracts simultaneously. Benchmark. The definition of the word benchmark in finance is a standard or point of reference against which the performance of an investment, fund, or portfolio can be measured. Imagine a long straight road through flat terrain. Beside the road at regular intervals are small concrete markers. Each one records a fixed distance from the origin. A benchmark is that marker. It does not move. It simply sits there, allowing a traveler to assess how far they have come or how far they have fallen behind. Common financial benchmarks include the S&P 500, the FTSE 100, and the Bloomberg U.S. Aggregate Bond Index. Fund managers are frequently evaluated on whether their returns exceed or fall short of their assigned benchmark. The difference between a fund's return and its benchmark return is called alpha. Positive alpha means the fund outperformed. Negative alpha means it underperformed. Passive investment funds do not attempt to beat a benchmark. They simply replicate it. Active managers argue that skilled stock selection can generate consistent outperformance. Evidence suggests this is difficult to achieve, particularly over long periods after fees are deducted. Benchmark selection matters. A fund measured against an inappropriate benchmark may appear to outperform or underperform for reasons unrelated to manager skill. Choosing the right benchmark is as important as understanding the performance it measures. Beneficiary. The definition of the word beneficiary is a person or entity designated to receive assets, benefits, or proceeds from a financial instrument, trust, will, or insurance policy. A beneficiary does not manage the asset. They receive it upon the occurrence of a specified event. Picture a sealed envelope in a drawer, set aside for a specific person, to be opened only when the time comes. The designation of a beneficiary is a formal legal act. It determines who will receive the proceeds of a life insurance policy upon the death of the insured. It determines who will inherit assets held in a retirement account. It specifies who will benefit from a trust. Beneficiary designations are powerful precisely because they operate outside of a will. Assets with a named beneficiary pass directly to that person, bypassing the probate process entirely. This makes beneficiary designations an important tool in estate planning. It also makes keeping them up to date essential. A beneficiary designation that has not been reviewed in years may no longer reflect the account holder's wishes. Life events such as marriage, divorce, the birth of a child, or the death of a named beneficiary should prompt an immediate review of all designations. Primary beneficiaries receive the assets first. Contingent beneficiaries receive them only if the primary beneficiary is unable to do so. The quiet paperwork of beneficiary designation is among the most consequential financial decisions a person can make. Beta. The definition of the word beta in finance is a measure of the volatility or systematic risk of a security or portfolio compared to the market as a whole. A beta of 1 indicates that the security moves in line with the market. Picture a pendulum. When the market swings left by 1 unit, a security with a beta of 1 also swings left by 1 unit. A beta greater than 1 suggests the security moves more than the market. A beta less than 1 suggests it moves less. A negative beta indicates the security tends to move in the opposite direction to the market, which can be useful for hedging. Beta is a component of the capital asset pricing model, used to calculate expected returns. A technology stock with a beta of 1.5 is expected to rise 15% when the market rises 10%, and fall 15% when the market falls 10%. A utility company with a beta of 0.5 moves more slowly in both directions. It offers less upside in rising markets but more protection in falling ones. Gold has historically exhibited a low or negative beta, which is part of its appeal as a portfolio diversifier. Beta is calculated using historical price data and therefore reflects past behavior. It is not a guarantee of future behavior. Investors who understand beta can construct portfolios with a desired level of market sensitivity. Bid price. The definition of the phrase bid price is the highest price that a buyer is willing to pay for a security at a given moment. In any marketplace, there are buyers and sellers. Buyers state the maximum they will pay. This is the bid. Picture an auction room. A painting is on the stage. The auctioneer reads out prices in ascending order. The bid is the most recent number called by a buyer. It is the price at which someone is currently prepared to transact. The difference between the bid price and the ask price, which is the lowest price a seller will accept, is called the bid-ask spread. Narrower spreads generally indicate a more liquid market. Wider spreads suggest lower liquidity or greater uncertainty. In electronic markets, the bid and ask prices are displayed in real time. The spread between them is visible to all participants. Market makers, firms that continuously quote both bid and ask prices, profit from this spread. They buy at the bid and sell at the ask, earning the difference on each transaction. For retail investors, the bid-ask spread represents a cost of trading. Buying at the ask and selling at the bid means entering and exiting a position at a slight disadvantage. In less liquid markets, spreads can be wide. This makes trading more costly and should be factored into investment decisions. Bid-ask spread. The definition of the phrase bid-ask spread is the difference between the highest price a buyer is willing to pay for a security and the lowest price a seller is willing to accept. The bid-ask spread is the cost of immediacy. It is what a trader pays to transact now, rather than waiting for a more favorable price. Imagine two merchants at a market stall. One says he will buy an item for $9. The other says she will sell it for $10. The spread is $1. A transaction occurs only if someone is willing to cross the spread. The buyer pays the ask. The seller receives the bid. In highly liquid markets, spreads can be fractions of a cent. In less liquid markets, they can be several percent of the asset's value. The bid-ask spread reflects several things simultaneously: the liquidity of the market, the uncertainty about the asset's true value, and the compensation required by market makers for the risk of holding inventory. During periods of market stress, spreads widen. This is because uncertainty increases the risk of holding positions, and market makers require greater compensation. The spread is an invisible tax on every trade. Frequent traders accumulate this cost rapidly. Long-term investors, who trade infrequently, are less affected. Understanding the bid-ask spread is essential for anyone who participates in financial markets. Bill of exchange. The definition of the phrase bill of exchange is a written order requiring one party to pay a fixed sum of money to another party at a predetermined future date or on demand. Picture a handwritten document, formally worded, passed across a trading table between two merchants in a distant century. It is a promise. A recorded obligation. Signed. Dated. Witnessed. Bills of exchange have been used in international trade for centuries, predating modern banking systems. Today they remain in use, particularly in international commerce, as a mechanism for extending credit between buyers and sellers across different countries. The party who writes the order is called the drawer. The party required to pay is the drawee. The party who will receive the payment is the payee. When the drawee signs the bill, accepting the obligation to pay, the document becomes an accepted bill. It is now a legally binding instrument. Bills of exchange can be traded. A seller who holds a bill due in 90 days may sell it to a third party at a discount in exchange for immediate cash. This process, known as discounting a bill, allows sellers to convert future receivables into present funds without waiting for the payment date. The discount applied reflects the time value of money and the creditworthiness of the parties involved. Black swan. The definition of the phrase black swan is an event that is extremely rare, has a severe impact, and is retrospectively rationalized as if it could have been predicted, when in fact it could not. The term was popularized by the author and statistician Nassim Nicholas Taleb, who drew on the historical assumption that all swans were white, an assumption shattered by the discovery of black swans in Australia. Before that discovery, a black swan was considered impossible. Afterward, it was obvious. A financial black swan is an event that falls entirely outside the range of normal expectation, yet carries enormous consequences. The 2008 financial crisis, the September 2001 attacks, and the sudden collapse of long-term capital management in 1998 have each been described as black swan events. The critical feature of a black swan is not its rarity. It is the fact that existing models and assumptions make it essentially invisible in advance. Standard financial models assume that asset price movements follow a normal distribution, a bell curve, with extreme events occurring only very rarely. Black swans expose the limits of this assumption. The practical implication is humility. No model captures everything. No forecast is complete. Building portfolios and institutions that can survive surprises, rather than simply optimizing for expected conditions, is a more honest form of risk management. Block trade. The definition of the phrase block trade is a large transaction involving a significant quantity of securities, typically executed outside of the open market to avoid disrupting prices. When a very large order is placed in the open market, it can move prices against the buyer or seller. A purchase of millions of shares may drive the price up before all shares are acquired. Block trades are arranged privately, often between institutional investors and broker-dealers, to avoid this market impact. Picture a very large ship that cannot dock at a standard port. Special arrangements must be made. A quieter berth is found. The cargo is transferred away from the public harbor. Block trades are the special berth of the financial world. In the United States, a block trade is traditionally defined as a transaction involving at least 10,000 shares or a value exceeding $200,000. In practice, institutional block trades are often far larger, involving hundreds of millions of dollars. Dark pools are private trading venues specifically designed to facilitate block trades without revealing order information to the broader market. Regulators require that block trades be reported after execution, ensuring transparency while allowing large participants to trade without undue market disruption. Blue chip. The definition of the phrase blue chip is a term used to describe a nationally recognized, well-established, and financially sound company. The phrase originates from poker, where blue chips traditionally carry the highest value. Imagine a very old building in a city center. Its facade is stone. Its name has been carved above the entrance for over 100 years. Inside, the operations are steady and methodical. The balance sheet is solid. The dividend has been paid consistently, year after year. Blue chip companies are typically large, stable, and capable of operating profitably during periods of economic difficulty. They are not always the fastest growing companies. They are, however, often among the most reliable. Blue chip stocks are considered suitable for conservative investors who prioritize capital preservation and steady income over aggressive growth. Many blue chip companies have paid uninterrupted dividends for decades, making them a foundation of income-oriented portfolios. The term is also used to describe other things of high quality and proven reliability. A blue chip athlete. A blue chip university. In each context, the meaning is the same. Stability. Proven performance. The reassurance of something that has endured. Bond. The definition of the word bond in finance is a fixed income instrument representing a loan made by an investor to a borrower, typically corporate or governmental. A bond is a promise. The borrower agrees to pay back the principal at a specified date, known as the maturity date, and to make regular interest payments, known as coupon payments, along the way. Picture a very long, very quiet corridor. At one end, a sum of money is handed over. At the other end, far in the distance, it will be returned. Along the corridor, at regular intervals, small envelopes are slid under a door. Each envelope contains the interest payment. Bonds are generally considered less volatile than equities. They are used by governments to fund public expenditure and by corporations to raise capital without issuing new shares. Government bonds are considered among the safest investments available. In stable economies, the risk of default is considered negligible. Corporate bonds carry higher risk than government bonds and therefore offer higher yields to compensate investors. Bonds are rated by credit rating agencies such as Moody's and Standard & Poor's. Investment-grade bonds are those rated above a certain threshold. Below that threshold, bonds are classified as high yield. The price of a bond fluctuates in the secondary market in response to changes in interest rates, credit quality, and economic conditions. Despite their complexity, bonds perform a simple and essential function. They allow borrowers to access capital and investors to receive a predictable stream of income. Bond ladder. The definition of the phrase bond ladder is an investment strategy in which a portfolio of bonds is constructed with staggered maturity dates, so that a portion of the portfolio matures at regular intervals. Picture a ladder lying on its side. Each rung represents a bond with a different maturity date. The rungs are evenly spaced. As the nearest rung is reached, that bond matures and the proceeds are reinvested in a new bond at the far end of the ladder. The ladder is never fully climbed. It is extended continuously. A bond ladder provides regular access to cash without requiring the investor to sell bonds in the secondary market. It also reduces reinvestment risk. Because bonds mature at different times, not all proceeds are reinvested at the same interest rate. If rates are low when one bond matures, the investor reinvests only a portion of the portfolio at that rate. The remaining bonds, locked in at earlier rates, continue to provide their original yield. Bond ladders are a common tool in retirement planning, providing predictable income streams that can be aligned with future expenses. They require patience and discipline to construct and maintain. But for those seeking steady, low-maintenance income, they offer a reliable framework. Bond rating. The definition of the phrase bond rating is an assessment of the creditworthiness of a bond issuer, expressed as a letter grade assigned by an independent rating agency. Bond ratings help investors evaluate the risk of lending money to a government or corporation. Picture a report card. The grades do not describe how interesting the student is. They describe one thing only: how reliably the student meets their obligations. The major rating agencies are Moody's, Standard & Poor's, and Fitch. Each uses a slightly different scale, but the underlying logic is the same. The highest ratings, such as AAA, indicate exceptional creditworthiness and very low default risk. These are typically assigned to stable governments and the strongest corporations. Lower ratings indicate higher risk. Bonds rated below a certain threshold are classified as speculative or high yield. They offer higher interest rates to compensate investors for accepting greater risk. A ratings downgrade can significantly increase a borrower's cost of debt. Many institutional investors are restricted by mandate from holding bonds below investment grade. A downgrade can therefore trigger forced selling. Rating agencies have been criticized, particularly in the aftermath of the 2008 financial crisis, for failing to adequately assess the risk of certain complex financial instruments. Despite these criticisms, bond ratings remain a foundational tool for fixed-income investors worldwide. Bond yield. The definition of the phrase bond yield is the return an investor realizes on a bond, expressed as a percentage of the bond's current market price. Bond yield and bond price move in opposite directions. When the price of a bond rises, its yield falls. When the price falls, its yield rises. Imagine water flowing through a pipe. When the pipe is wide, water flows easily. When the pipe narrows, the pressure increases. Yield is the pressure in that pipe. It tells you not just the return on paper but the return given what you actually paid. The yield to maturity is the most comprehensive measure. It accounts for all future coupon payments and the return of principal at maturity. The yield curve plots bond yields against their maturity dates. In normal conditions, longer-dated bonds yield more than shorter-dated ones, reflecting the additional risk of lending for a longer period. When this relationship inverts, with short-term yields rising above long-term yields, it is known as an inverted yield curve. This has historically been a reliable predictor of economic recession. Government bond yields serve as a reference rate for borrowing costs throughout the economy. Mortgage rates, corporate borrowing costs, and consumer loan rates are all influenced by the level of government bond yields. Watching bond yields is, in many ways, watching the pulse of the economy. Book runner. The definition of the phrase book runner is the lead investment bank responsible for managing the process of issuing new securities, particularly in an initial public offering or bond issuance. When a company decides to raise capital through a public offering, it appoints an investment bank to manage the process. The book runner organizes the roadshow, in which company management presents to potential investors. It builds the order book, collecting indications of interest from institutional investors. Imagine a conductor standing before an orchestra. Each musician represents a different investor or syndicate member. The conductor does not play an instrument. The conductor coordinates. The book runner sets the terms, allocates shares, and stabilizes the price in the immediate period following the offering. The term book refers to the record of investor orders that the bank maintains during the offering process. Building this book is the central task. Large offerings often involve multiple banks. The lead book runner has overall responsibility. Co-managers assist with distribution. The book runner earns fees based on the total size of the offering, typically expressed as a percentage of the proceeds raised. In a well-managed offering, the book is oversubscribed, meaning demand exceeds supply. The book runner must then allocate shares among competing investors, a task that requires judgment and relationships. Book value. The definition of the phrase book value is the value of an asset as it appears on a company's balance sheet, calculated as the original cost of the asset minus any accumulated depreciation. Think of a vehicle that was purchased new 5 years ago. Its original purchase price was recorded in the accounts. Each year, a portion of that value was subtracted to reflect wear and aging. What remains is the book value. It does not reflect what the vehicle would sell for today. It reflects what remains on the accounting record. Book value is used by analysts to assess whether a company's shares are trading above or below the underlying value of its assets. The price-to-book ratio compares the market price of a share to its book value per share. A price-to-book ratio below 1 suggests the market values the company at less than its net assets. This can indicate undervaluation, or it can signal that investors expect the assets to lose value. A price-to-book ratio significantly above 1 suggests the market is attributing value beyond the physical assets on the balance sheet, typically reflecting intangibles such as brand value, intellectual property, or future earning potential. Book value is most useful when assessing asset-heavy businesses such as banks, manufacturers, and real estate companies. It is a starting point, not a conclusion. Bottom line. The definition of the phrase bottom line is the final figure in a financial statement, specifically the net income or net profit of a company after all expenses, taxes, and costs have been deducted. The term originates literally from accounting. The bottom line of an income statement is where the final profit or loss figure appears. Picture a long column of numbers, descending a page. Operating costs. Salaries. Depreciation. Interest. Tax. At the very bottom of the column, a single figure remains. It is circled. It is what is left. Net income is the figure from which dividends are paid and retained earnings are calculated. It is the number that shareholders, analysts, and management watch most closely. A company can show strong revenue growth while the bottom line remains flat or negative, if costs are rising faster than income. Conversely, a company with modest revenue growth can improve its bottom line through cost efficiency, better margins, or reduced tax exposure. Improving the bottom line is not always a sign of health. Aggressive cost-cutting may improve net income in the short term while undermining the business's capacity to grow. Context matters. The bottom line is important. But it is the beginning of analysis, not the end. Brand equity. The definition of the phrase brand equity is the commercial value that derives from consumer perception of a brand, rather than from the physical product or service itself. Brand equity is what allows one product to command a higher price than a functionally identical competitor. Picture two bottles of water, drawn from the same source, filled at the same facility, indistinguishable in composition. One carries a well-known label. The other carries none. The labeled bottle sells for more. Not because the water is different. Because the perception of the water is different. Brand equity is built over time through consistent quality, effective marketing, and the accumulation of customer experiences. It can be positive, adding value above the intrinsic worth of the product, or negative, where a tarnished reputation reduces the perceived value of even a functional offering. Strong brand equity allows companies to extend into new product categories with greater ease. It provides pricing power, reduces customer acquisition costs, and creates resilience during periods of competition or controversy. Brand equity is difficult to measure precisely. Analysts use proxies such as price premium, customer loyalty metrics, and market share to estimate its value. In acquisitions, brand equity is often a primary driver of the premium paid above book value. It is the intangible that makes a business worth more than the sum of its parts. Break-even point. The definition of the phrase break-even point is the level of production or sales at which total revenues equal total costs, resulting in neither profit nor loss. Imagine a set of scales. On one side, costs. On the other, revenue. At the break-even point, the scales are level. Nothing is gained. Nothing is lost. Businesses calculate their break-even point to understand the minimum performance required to avoid a loss. The break-even point is calculated by dividing fixed costs by the contribution margin per unit, which is the selling price per unit minus the variable cost per unit. Fixed costs are those that do not change with output, such as rent, salaries, and insurance. Variable costs change in proportion to output, such as raw materials and packaging. The break-even point moves as costs and prices change. A rent increase raises the break-even point. A reduction in material costs lowers it. For a new business, the break-even point is a critical milestone. Reaching it means the business is no longer consuming capital simply to exist. Break-even analysis is also used to evaluate pricing decisions, investment proposals, and the impact of changes in the cost structure. It is a simple tool, but one that brings immediate clarity to the question of whether a business can sustain itself. Breakout. The definition of the word breakout in financial markets is the movement of an asset's price above a defined resistance level or below a defined support level, typically accompanied by increased trading volume. Technical analysts study price charts looking for patterns. Within those patterns, certain price levels appear repeatedly. Picture a lake surrounded by cliffs. The water level rises gradually. For a long time, it remains below the cliff edge. Then, one day, the water spills over. It moves into new territory. This is a breakout. A breakout above resistance may signal continued upward momentum. A breakout below support may signal continued decline. Not all breakouts sustain. Some are false breakouts, in which the price returns quickly to its previous range. High volume accompanying a breakout suggests strong conviction among buyers or sellers. Low volume suggests the move may lack follow-through. Traders often place entry orders just beyond key resistance or support levels, intending to capture the momentum of a confirmed breakout. Stop-loss orders are placed on the other side of the breakout level, to limit losses if the move reverses. Breakout trading requires patience. Many potential breakouts fail. The discipline lies in waiting for clear confirmation before committing capital. Bridge loan. The definition of the phrase bridge loan is a short-term loan used to bridge the gap between an immediate financing need and the availability of longer-term funding. Bridge loans are commonly used in real estate when a buyer wishes to purchase a new property before selling an existing one. Picture a traveler who needs to cross a river. The permanent bridge is under construction and will not be ready for several months. A temporary structure is erected to allow passage in the meantime. The bridge loan is that temporary structure. It provides access now, with the understanding that it will be replaced by something more permanent. Bridge loans typically carry higher interest rates than conventional loans, reflecting their short-term nature and the speed with which they are arranged. In business, bridge loans are used to fund operations between funding rounds or to complete an acquisition while permanent financing is arranged. The defining characteristic of a bridge loan is its brevity. It is not intended to be held for years. It is a transitional instrument, useful precisely because of its temporary nature. Careful planning is essential when using a bridge loan. The permanent financing it bridges must be secured before the loan comes due. Failure to do so can create significant financial pressure. Broad money. The definition of the phrase broad money is a measure of the total money supply in an economy, encompassing not only physical currency and demand deposits but also savings accounts, money market funds, and other near-liquid assets. Broad money provides a more complete picture of the financial resources available to individuals and businesses than narrow measures of money supply. Picture a river system. The main channel is narrow money, cash and immediately accessible deposits. The tributaries, streams, and reservoirs feeding into it form the broader system of savings and near-cash assets. The most commonly used measure of broad money in the United States is M2, which includes physical currency, checking accounts, savings accounts, and small denomination time deposits. Central banks monitor broad money closely because changes in its level can signal future inflationary or deflationary pressures. When broad money grows rapidly, it suggests that there is more purchasing power available in the economy, which can lead to rising prices if not matched by growth in output. When broad money contracts, it can signal tightening financial conditions and reduced economic activity. Quantitative easing, the process by which central banks create new money to purchase assets, directly increases the broad money supply. Broker-dealer. The definition of the phrase broker-dealer is a financial firm that acts both as a broker, executing trades on behalf of clients, and as a dealer, trading securities for its own account. When acting as a broker, the firm earns a commission for matching buyers and sellers. When acting as a dealer, the firm buys securities and holds them in inventory, profiting from the difference between the price at which it buys and the price at which it sells. Picture a merchant who both matches buyers with sellers in a marketplace and also maintains a private stock of goods to sell directly. 2 roles. 1 entity. Broker-dealers are regulated in most jurisdictions and are required to disclose to clients when they are acting in each capacity. In the United States, broker-dealers are registered with the Securities and Exchange Commission and are members of the Financial Industry Regulatory Authority. When a broker-dealer acts as a principal, it must disclose this to the client. The client is entitled to know whether their counterparty is a market participant or an independent intermediary. Conflicts of interest can arise when a broker-dealer acts in both capacities. Regulatory frameworks are designed to manage these conflicts and ensure that client interests are not compromised. Despite the potential for conflict, broker-dealers play an essential role in providing liquidity to financial markets. Brokerage. The definition of the word brokerage is a firm or individual that acts as an intermediary between buyers and sellers of financial instruments, earning a commission or fee for facilitating the transaction. Picture a busy junction. Cars travel in many directions. In the center, a figure directs the flow, ensuring that vehicles moving in opposite directions are matched efficiently. A brokerage performs this function in financial markets. It does not typically buy or sell for its own account. It connects parties who wish to transact. Full-service brokerages offer research, advice, and portfolio management alongside transaction execution. Discount brokerages offer execution only, at lower cost. The commission charged by a brokerage is called a brokerage fee. Over the past 2 decades, brokerage fees have declined dramatically. Many online platforms now offer commission-free trading, generating revenue through payment for order flow and interest on client cash balances. The rise of commission-free trading has democratized access to financial markets, allowing investors with modest means to transact at the same cost as those with large portfolios. Choosing a brokerage involves considering not just cost, but the quality of the platform, the range of available instruments, customer service, and the financial stability of the firm. A brokerage holds its clients' assets in custody. The security of those assets depends on the regulatory framework governing the firm and the protections offered in the event of insolvency. Budget. The definition of the word budget is a financial plan that estimates revenues and expenses over a specified future period. A budget is not a record of what has happened. It is a plan for what is expected to happen. Picture a calendar pinned to a wall. Beside each month, a set of figures. Projected income on one line. Projected expenditure on the next. The budget does not promise accuracy. It provides a framework against which actual results can later be compared. In government, budgets are presented publicly and debated. In business, they guide resource allocation. In households, they support financial discipline. The word budget is derived from the Old French budget, meaning small leather bag, referring to the bag in which a treasurer would carry financial documents. A capital budget addresses long-term investments in assets such as property, equipment, and technology. An operating budget addresses the day-to-day revenues and expenses of running an organization. Variance analysis compares actual results to budgeted figures. Where actuals exceed budget, a favorable variance is recorded. Where actuals fall short, an unfavorable variance is noted. A zero-based budget requires every expense to be justified from scratch, regardless of whether it was included in previous budgets. Budgeting is not a glamorous task. It is, however, one of the most important habits a household, business, or government can develop. Budget deficit. The definition of the phrase budget deficit is the amount by which a government's expenditure exceeds its revenues in a given period. When a government spends more than it collects in taxes and other revenues, it runs a deficit. Picture a household in which each month's expenses consistently exceed the monthly income. The shortfall does not disappear. It must be financed, typically by borrowing. Governments finance deficits by issuing bonds. These bonds represent a promise to repay, with interest, in the future. A structural deficit is one that persists regardless of the economic cycle. A cyclical deficit is one that arises during periods of economic slowdown and resolves during recovery. The accumulation of annual deficits forms the national debt. Economists debate the appropriate level of deficit spending. Keynesian economists argue that deficit spending during recession supports economic activity and reduces unemployment. Critics of deficit spending argue that persistent deficits crowd out private investment, increase future tax burdens, and can ultimately undermine confidence in a government's ability to meet its obligations. Most developed economies have run budget deficits for extended periods. The relationship between deficits, debt, and economic performance is complex and contested. What is certain is that the choice to run a deficit is a choice with long-term consequences. Budget surplus. The definition of the phrase budget surplus is the amount by which a government's revenues exceed its expenditure in a given period. A budget surplus is the opposite of a deficit. It occurs when more is collected than is spent. Picture a reservoir after a season of heavy rain. The water level has risen above the usual mark. There is more than enough. A government running a surplus has options. It can use the excess to pay down existing debt, reducing the burden of future interest payments. It can save it in a sovereign wealth fund for future use. Or it can return it to citizens through tax reductions. Budget surpluses are relatively rare among large economies. They require either high revenues, low expenditure, or both, over a sustained period. Norway, buoyed by oil revenues, has maintained significant surpluses and accumulated one of the largest sovereign wealth funds in the world. A surplus is not inherently virtuous. Running a large surplus during a recession may indicate that a government is withdrawing too much from the economy at a time when support is needed. Context determines whether a surplus is a sign of fiscal health or fiscal misjudgment. Bull market. The definition of the phrase bull market is a market condition characterized by rising prices, typically a rise of 20% or more from recent lows, accompanied by investor confidence and optimism. Picture an open field in early spring. The ground is warming. The light is returning. Animals move with more energy than they did in winter. A bull market does not always feel like prosperity in the moment. It builds gradually, driven by economic growth, low unemployment, and rising corporate earnings. The bull is thought to represent an upward thrust of the horns, in contrast to the downward swipe of the bear. Bull markets have historically lasted longer than bear markets. The longest bull market in United States history ran from 2009 to 2020. During a bull market, investor sentiment is generally positive. Confidence encourages spending and investment, which in turn supports corporate earnings and further price appreciation. Not all assets rise equally in a bull market. Growth stocks tend to outperform in periods of optimism. The challenge of a bull market is complacency. Rising prices can encourage excessive risk-taking, the assumption that conditions will continue indefinitely, and the underestimation of downside risk. Every bull market in history has eventually ended. Recognizing the signs of excess and maintaining discipline during periods of optimism is as important as knowing when to participate. Bull trap. The definition of the phrase bull trap is a false signal in financial markets that causes buyers to believe that a declining asset has reversed into an uptrend, when in fact the decline is set to continue. A bull trap is the mirror image of a bear trap. Picture a traveler who has been walking downhill for a long time. Suddenly the path appears to level out. There is even a slight incline upward. The traveler believes the descent is over. Then the ground falls away again, steeply. The respite was temporary. The trap has closed. In markets, a bull trap occurs when prices briefly recover during a broader downtrend, drawing in optimistic buyers. Then the decline resumes, leaving those buyers with losses. Bull traps are common during bear markets. Each recovery can feel like the beginning of a new uptrend. Some are. Many are not. Distinguishing a genuine reversal from a bull trap requires patience and confirmation. A sustained move accompanied by improving fundamentals and increasing volume is more likely to be genuine. The emotional toll of a bull trap is significant. Buyers who entered with optimism are quickly underwater. The temptation to hold and hope is strong. Discipline requires accepting the loss and reassessing, rather than waiting for a recovery that may not come. Bullet bond. The definition of the phrase bullet bond is a bond that pays regular interest throughout its life and repays the entire principal in a single payment at maturity, rather than amortizing the principal over time. The word bullet refers to the single, final repayment of the full principal amount at the end of the bond's life. Picture a long corridor with small doors along the sides. Behind each door is an interest payment, delivered at regular intervals over the life of the bond. At the very end of the corridor is a large door. Behind it is the entire principal. Bullet bonds are the most common structure in the government and corporate bond markets. They differ from amortizing bonds, which repay a portion of the principal with each periodic payment, gradually reducing the outstanding amount until nothing remains at maturity. For issuers, bullet bonds provide the full use of the borrowed funds until the maturity date, with no obligation to return any principal in the interim. For investors, bullet bonds provide predictable cash flows in the form of regular coupons and a known repayment date for the principal. The duration of a bullet bond, a measure of its sensitivity to interest rate changes, is higher than that of an equivalent amortizing bond, because the principal is not returned until the very end. Burn rate. The definition of the phrase burn rate is the rate at which a company spends its available cash before generating positive cash flow from operations. The term is most commonly used in the context of early-stage companies and startups. Picture a candle on a table. It was lit when the company was founded. Its height represents the available cash. Each day, the candle shortens. The burn rate measures how much of the candle is consumed each month. A high burn rate relative to available funds results in a short runway, the period of time before the company runs out of cash. Investors and founders monitor burn rate closely to determine when additional funding will be required. Gross burn rate refers to total monthly cash expenditure. Net burn rate refers to monthly cash expenditure minus any revenue generated. A company with a gross burn of $500,000 per month and revenue of $100,000 per month has a net burn rate of $400,000. With $2 million in the bank and a net burn of $400,000 per month, the runway is 5 months. Managing burn rate is one of the primary disciplines of startup finance. It requires making difficult choices about headcount, marketing spend, and the pace of product development. The goal is to reach profitability, or the next funding milestone, before the candle burns out. Business cycle. The definition of the phrase business cycle is the recurring pattern of expansion and contraction in economic activity that an economy experiences over time. A business cycle does not follow a fixed schedule. It is not a calendar. It is a rhythm. Unlike all rhythms, it has periods of activity and periods of rest. Picture a tide. It comes in slowly. It reaches a peak. It recedes gradually. It reaches a trough. Then it returns. The 4 phases of a business cycle are expansion, peak, contraction, and trough. During expansion, employment rises, incomes grow, and spending increases. During contraction, the reverse occurs. In the United States, the National Bureau of Economic Research is responsible for officially dating the peaks and troughs of business cycles. A recession is defined as a significant decline in economic activity lasting more than a few months. The average business cycle in the United States has historically lasted approximately 5 to 7 years, though this varies considerably. Central banks attempt to moderate the cycle through monetary policy, raising interest rates during expansions to cool inflation, and lowering them during contractions to stimulate activity. No policy tool eliminates the business cycle. It is a fundamental feature of market economies. Understanding its phases helps businesses, investors, and individuals make better decisions at each stage. Business valuation. The definition of the phrase business valuation is the process of determining the economic value of a business or company. Business valuation is required in a wide range of circumstances. The sale of a business, a merger or acquisition, the admission of a new partner, estate planning, litigation, taxation. Picture a house that has never been listed for sale. It has value, clearly. But what value? To answer that question requires examination. A valuer will consider the business's assets, its earnings history, its future prospects, its competitive position, and the conditions prevailing in the market for similar businesses. 3 broad approaches are used in business valuation. The income approach values the business based on its capacity to generate future cash flows. The market approach compares the business to similar companies that have recently been sold or listed. The asset approach values the business based on the net value of its assets. Each approach yields a different result. Professional valuers typically use multiple approaches and reconcile the results to arrive at a final opinion of value. Business valuation is as much an art as a science. Reasonable professionals can examine the same business and reach significantly different conclusions. The value of a business is ultimately what a willing buyer will pay a willing seller, in an arm's-length transaction, with both parties fully informed. Buy and hold. The definition of the phrase buy and hold is an investment strategy in which an investor purchases securities and retains them for an extended period, regardless of short-term market fluctuations. The buy and hold investor is not concerned with the noise of day-to-day price movements. Picture a gardener who plants a tree. They do not dig it up each autumn to check the roots. They water it. They wait. They trust that time will allow it to grow. The strategy is premised on the belief that, despite short-term volatility, markets tend to rise over long periods. Warren Buffett is perhaps the most well-known proponent of the buy and hold philosophy. The strategy minimizes transaction costs and tax events, both of which erode investment returns over time. Studies consistently show that the average investor underperforms the market, largely due to the tendency to buy after prices have risen and sell after prices have fallen. Patience is the essential quality of the buy and hold investor. Watching a portfolio decline in value during a bear market without selling requires a temperament that is not common. The strategy is most effective when applied to broadly diversified portfolios. Time is the most reliable ally of the patient investor. The buy and hold strategy is, at its core, a commitment to letting time do its work. Buyback. The definition of the word buyback, also known as a share repurchase, is the process by which a company purchases its own shares from the marketplace. When a company buys back its own shares, the total number of shares outstanding decreases. This typically increases earnings per share and can support the share price. Imagine a baker who baked 100 loaves and sold them all to the market. Later, with excess funds, the baker returns to the market and buys back 20 loaves. Fewer loaves remain in circulation. Each remaining loaf represents a larger portion of the total. Companies execute buybacks when they believe their shares are undervalued, or when they have excess capital with no immediate investment opportunity. Unlike dividends, which are taxed as income, buybacks allow shareholders to choose when to realize gains by selling their shares. This provides a tax efficiency that dividends do not. Critics of buybacks argue that companies sometimes repurchase shares at inflated prices, destroying value in the process. They also argue that funds spent on buybacks could be more productively invested in research, equipment, or employees. In the United States, share buybacks have become a significant feature of corporate finance, with large companies spending hundreds of billions of dollars annually on repurchases. The merits of buybacks depend entirely on the price paid and the alternatives available. At the right price, a buyback creates value. At the wrong price, it does not. Buyout. The definition of the word buyout is the purchase of a controlling interest in a company, typically by acquiring a majority of its shares. A leveraged buyout is a specific type of buyout in which the purchase is financed largely with borrowed funds, using the assets of the acquired company as collateral. Picture a building that has stood under the same ownership for many years. One day, a new set of keys is cut. The deed changes hands. The building remains. The operations continue. But the decisions about its future now rest with a different party. Buyouts are common in private equity. They allow firms to acquire companies, restructure them, and eventually sell them at a profit. Management buyouts occur when the existing management team acquires the company they operate. In a leveraged buyout, the debt used to finance the acquisition is placed on the balance sheet of the acquired company. The company must then generate sufficient cash flow to service this debt. This creates both opportunity and pressure. The pressure of debt can focus management on operational efficiency. It can also, if cash flows disappoint, lead to financial distress. Private equity firms typically hold their buyout investments for 3 to 7 years before seeking an exit through a sale, a merger, or a public offering. The fees charged by private equity firms in the context of buyouts have attracted significant debate about the alignment of interests between managers and investors. And with that final definition, we close the ledger for tonight. The alphabet of wealth is vast, but there is no need to master it all in one sitting. For now, let the terms we have discussed tonight, from backdating to buyouts, fade into the background of your mind. If you found peace in tonight's journey, remember that this library is always here for you, growing one quiet letter at a time. If you enjoyed this video, please consider liking and subscribing to the channel. For other helpful financial resources, check the links in the description. Which word put you to sleep? We would love to know. Leave it in the comments below. But for now, the business of the day is concluded. The markets are silent. Your mind is still, and your only remaining task is to rest. I am Simon Grant. Thank you for listening to this video. Good night.